Well, this is a question that I'm thrilled that you guys are asking about because this is one of my hottest topics in negotiating LOIs and LPAs.
Welcome to BuzzHouse, a Baker Tilly podcast where you can find all the buzz around multifamily housing. I'm Don Bernards, the partner in charge of Baker Tilly's multifamily housing practice.
And I'm Garrett Gibson, a partner at Baker Tilly, also specializing in consulting on multifamily housing transactions across the country.
Each week, we'll bring you a guest or a topic in the multifamily housing industry that will help you win now and anticipate tomorrow. Let's get started. Today, our guest in the BuzzHouse is Jon Peterson, an attorney and shareholder at the law firm Winthrop Weinstine. Jon specializes in working with developers on low-income housing and other real estate deals involving tax credits. We'll be talking with Jon today about some hot topics and issues around LIHTC deals with a focus on components of equity LOIs as well as partnership agreements. Before turning to Jon to discuss these topics, we're going to give you a few updates around the industry. There's been a lot of discussion in the renewable energy space as of late, specifically around solar tax credits and tax credits such as the 45L energy efficiency credit. Many projects we've worked on with our LIHTC developers have utilized some of these energy credits. And those of you who've been following the solar credit saw the percentage drop from 30% for qualifying costs placed in service in 2019 to 26% in 2020, down to 22% next year in 2021, and then down to 10% thereafter. With the 45L energy efficiency credit, which we will plan to have a podcast on shortly, the credit is in place for qualifying units placed in service through December 31st, 2020. This again is a $2,000 per qualifying unit federal credit. The discussion around all of these renewable energy credits are they going to be extended, at what percentages, and so forth. So a lot may hinge as well on the presidential election, and we'll continue to follow these resources and keep you updated on those. Switching gears to news in the tax-exempt bond space, as well as public housing, kind of very interesting. A bill was recently introduced in the House, and this is kind of a mouthful, entitled Support Allowing Volume Exception for Federally Assisted Housing Act. So again, kind of a mouthful. This bill would allow tax-exempt bonds used to finance the preservation of public housing, along with other federally assisted buildings, to be exempt from the state's bond volume cap. As many of you know, we've discussed, many states are using their full volume cap, not allowing any more 4% deals to move forward once you reach that cap. This, again, would allow specifically public housing and other federally subsidized projects to move forward, exempt from the standard volume cap. So we'll keep that, again, as a House bill. It does have bipartisan support from affordable housing advocates, and so we'll continue to follow this legislation. And finally, just a couple of recently frequently asked questions have been published around the industry. One is regarding implementation of the Centers for Disease Control and Prevention's eviction moratorium order, which of course went into effective September 4th and remains in effect through December 31st. And the second FAQ recently published is an updated COVID-19 questions and answers from the Office of Multifamily Housing Stakeholders through HUD, talking about things around related to the CDC's eviction moratorium, as well as REAC inspections and a few other items. We can provide links to those on our podcast site. Now, we're excited to bring in Jon Peterson from Winthrop Weinstine. Jon, thank you for joining us today. Maybe just start out telling our listeners, what's your practice area at Winthrop?
My practice area is mainly focused on the development of affordable housing all throughout the country. Our main office is located in Minnesota, but I probably do 20% to 25% of all the affordable housing in Colorado and North Dakota, and our firm does a lot of work really throughout the entire country. We're very fortunate to have developer clients who are dispersed nationally. And so one of the real interesting aspects of some of the discussions in this podcast is we can give both a fairly regional view within Minnesota and Wisconsin and a fairly national view on what's happening in some of the broader markets in California, Florida, and some of these other areas.
All right, Jon, thanks for joining us. So why don't we go ahead and move into a few questions Don and I have. Why don't we start off with a hot topic of special allocations. So what are you seeing with special allocations in low-income housing tax credit deals, especially more so on bond deals?
Yeah, the question of special allocations arises in bond deals mainly because we are faced with a situation where we may have challenges in our underwriting and delivery of tax credits. Of course, our investors in these low-income housing tax credit deals are making investments on a yield basis, meaning that they're looking to receive an allocation of taxable losses and tax credits under the requirements of Section 704 of the Internal Revenue Code. And to the extent that we have negative capital accounts that arise in any of those years, the allocation of those benefits in terms of losses and tax credits may be prohibited and may need to be reallocated to the general partner. So one way we manage that risk for our investors is we reduce the amount of losses, which has the impact of not causing the capital accounts to be decreased as quickly. And the real time frame where we typically are looking at would be in years 10 to 11 of the tax credit period, where we find out that that's most often where a negative capital account might prohibit the allocation of tax credits to the investors. And so while our underwriting is always somewhat speculative based on the market and what we think will happen, what we do with our investors is we conduct a series of special allocations of specific items of expenses or losses that would be allocated away from the investor to the general partner, so that our projections show that we have a positive capital account at least through years 10 or 11. This is something that years ago we used to propose to investors. I'm talking 10, 15 years ago. And we found a fair amount of hesitation and pushback on using special allocations because some investors were concerned that a special allocation might mean that the investor isn't able to receive an allocation of what's normally 99.99% of the tax credits. And I think the industry has matured somewhat in that regard over the last several years because we're seeing a much greater acceptance of special allocations. And it's a pretty useful tool, but it really begs the question of whether you have a need for special allocations. And you really only discover that by having a pretty comprehensive and thorough analysis of projections involving a capital account analysis that would be done early in the deal. And we typically like to have these discussions with the investors at the LOI stage if we can, which means that the developer really needs to put those projections together. So having a team that can help understand how to put together comprehensive projections, I think becomes very important at an early stage.
Thank you, John. That was a lot of really good information and things to think about. We've a lot of 4% deals going on around the country, a lot of these issues. So, John, one other, speaking of 4% deals, we've talked in this podcast and many others in the industry, will the 4% rate get fixed? And how it kind of ties back into this discussion of LOIs and so forth is there opportunities to negotiate, some type of upward adjuster, into an LOI in case there's a 4% fixed rate? What are you talking about with your clients around that kind of?
Well, we saw a similar situation several years ago where the 9% credit used to float based on publications of the rates by the IRS. And of course, now the 9% rate is fixed. And when that rate was fixed, depending on how our clients had decided to determine the effectiveness of the 9% rate, some of our clients really benefited in a material way when that was fixed by getting when at the time it was probably about a 7.5% rate bumped up to a 9% rate. And then they were able to receive additional credits on that. The real issue that comes up is that if you get that bump in credits of which in this case, our current rate is, around 3.07% up to 4%, that's almost a 25% increase in your credits. And with a 4% bond deal, we're not capped in terms of the total amount of credits like we would be in a 9% deal. Now we might have to get a new 42M letter and do some other aspects to make sure that those credits would all be flowing through to the partnership, but there's a pretty good chance that you wouldn't have any issue in making sure those credits get to the partnership. So then the question is, if you have those tax credits that come in, can you monetize those with the investor? And the issue that arises is, can you monetize them in terms of an upward adjuster? Because more often than not, we find investors limiting their commitment to additional credits for capital contributions of 5% of the overall investment that they would make. And as we were just talking about, if our credit rate went from 3.07 to 4%, that's closer to a 25% increase. So if you, in a worst case scenario, you run the risk that you could have an investor who says, well, we're not obligated to pay for any extra credits, but we still get them, and they could get them for free. So then the question is, okay, well, if we get the upward fixed rate at 4%, can we get an investor to obligate to make a capital contribution for those credits? And I would say it's our experience with that. It's something that we negotiate in our LOIs, and we're probably at about a 50-50 success rate. Some will say yes, and some will say no. And then the other piece of it would be, okay, well, if they will be obligated to make an additional capital contribution, what's the rate? And the one piece there that I think is fairly universal is the investors typically won't commit to the same pricing as the original deal. What they'll say is they'll make a commitment to acquire or to make a capital contribution for the additional credits, but they want it to be yield neutral. So, for example, if they were investing at a 5% yield, they would kind of back into the pricing of the credits so that with the additional credits, they would still maintain a 5% yield. I would say there's two things on this, one of which would be if you want the investor to consider this is something that it would be a good idea to put into an LOI, even though I would say when the 9% rate was fixed, we had pretty good success rate, even if we were over the amount of the upward adjuster in the LPA of having investors put in capital to acquire those additional credits. The other, for a for-profit investor in particular, the other option could be to say, well, if the investor isn't going to make a capital contribution for those credits, then let's reduce the investor's overall interest in the deal and allocate some of those credits to the for-profit investor, which I think is a good backup if you can't get there with the upward adjuster.
Yeah, that's some good stuff. A lot to think about, in terms of whether or not that situation might occur. We all have our fingers crossed, and I think we're all looking for the 4% fix there. I'll switch to another topic that we've been working through, a lot of year 15 exits with a lot of developers and owners. So what are you seeing in terms of new deals on being able to sort of alter the typical boilerplate language that's been there before and LPAs to address some of the exit issues that seem to always come up?
Well, this is a question that I'm thrilled that you guys are asking about, because this is one of my hottest topics in negotiating LOIs and LPAs. The economics of deals, as we see, particularly in a more major metropolitan area, work out where about half of the economics to the developer come in the form of the developer fee in the first, call it 5 years of the deal. And about the other half, close to half of the economics in the deal come in appreciation and debt pay down over 15 years, over the 15-year period. And we find, after being through a lot of these year 15 exits, that there's a lot of value that often is in these deals in year 15. So how can we maximize that value as we're representing the developers to the developer group? And that really comes in two ways. One of which is if you have a purchase option or a right of first refusal, to make sure that the price is, that right of first refusal or purchase option applies to the fair market value of the interests. So rather than only applying to the property and having the investor receive what the investor would receive under the cash flow waterfall, the value of the interest we find on a discounted cash flow analysis typically is quite a bit less than the residual equity in the deal. So having that flexibility in your purchase option or right of first refusal is, if you're a for-profit, is really important. The other aspect of that is to make sure that the investor can't prohibit the exercise of the right of first refusal or purchase option through language such as if there is an offer that the partnership receives that the investor determines it should accept, or any other language that might give the investor some ability to prohibit the exercise of either a purchase option or right of first refusal. The other piece of this where, candidly, our firm has been involved in some litigation with uncooperative investors has been, you see many investors say that on the sale of a project that the capital must be distributed in accordance with positive capital accounts. And our approach on that is that when a project is sold, you can't disregard the sale or residual waterfall. So the proceeds from the sale need to go through the waterfall first, and then the provisions relating to a dissolution and the distribution in accordance with a positive capital account would come into play. And to give you some idea, we recently litigated a case in Seattle for, that was a published case, so I think I'm comfortable in saying this is the Downtown Action to Save Housing, the DASH case. And there the investor said that in order for DASH to be able to exercise a right or for their buyout option, they would have to pay the investor, I believe it was about $1.2 million. And the court looked at a discounted cash flow analysis and determined the fair market value of the interest of the investor to be $60,000. And so that's all that the investor had to pay to get the investor out of the deal. So these year 15 issues are really, really important. And it's important that you've got good accountants and lawyers that can help you work through those issues, because you could be leaving a lot of money on the table if that isn't something that's analyzed thoroughly at the beginning of the deal.
Yeah, I always stress to clients that they really need to I know development is difficult and there's a lot of things to think about, but when you're negotiating those LPA disclosures is to really pay attention to what that exit language is. So that's great. So we got a couple more questions. John, what are some of the other items you were addressing in a lot of LPAs? When we were talking earlier, you mentioned some items such as refinancing, removal rights, indemnities. What are you seeing in these areas?
Well, in some of the language that we've really been pushing on dovetails into some of the year 15 discussion we were just talking about. So for example, one of our cases that one of our groups litigated against a limited partner involved a situation where a first mortgage loan had come to maturity, and the LPA said that the partnership couldn't refinance without the consent of the investor limited partner. And the investor limited partner said, well, we're only going to give you the consent if you pay us a really big exit price. And that's prompted a lot of the attorneys in our firm to say, well, we need some flexibility in terms of refinancing, in particular, after the end of the credit period. And so we've had a fair amount of success as of late in adding provisions such as we can refinance if certain parameters are met, such as if it's not a cash out refinance, if there's a minimum 1.20 debt service coverage ratio, and if otherwise it doesn't impact any allocations to the investor. And that would effectively eliminate the argument that I just described, where an investor could kind of hold a developer ransom, if you would, for not giving a consent to a refinance. Other areas where we continue to push and where we see success are just having some, and some of this again relates to year 15 issues, but having conditions, more conditions on the ability of an investor to remove a general partner. So there has to be some material adverse harm. There needs to be situations where the project is really being compromised and it's not more or less in the discretion of the investor, which you sometimes used to see in the past. Another area where we have been seeing some changes in LPAs have been in terms of adjusters for depreciation, sometimes triggered with a cost segregation analysis. And we're seeing many more of these cost segregation analysis being put into play, which I actually think I've been surprised that these weren't something that investors were asking for years ago, because it accelerates the number of losses that are available in early years. But when it comes to a depreciation adjuster, that's been something that we've seen fairly often, and we've had a fair amount of success in having stricken. And I'd say the last thing that we are seeing more often that I tend to have a fair amount of success in striking would be an exit fee or a sales fee at the end of year 15 in favor of the investor. It's not unusual to see a $30,000 to $100,000 fee payable to the investor on sale of the project or sale of the interests, which would be in addition to any purchase option price. And that would be something that I would suggest we just really try to push against.
Thanks, John. Those are great suggestions for folks to think about while they're in negotiations with their limited partnership agreements. We do have one last question for you. What are you seeing with clients in current trends with bond deals?
Well, bond deals seem to vary based on the market. And so in terms of development using bond deals, one thing that has been fairly interesting, I think, and this tends to be with larger projects, but in areas that have higher area median incomes, such as California, Florida, we're seeing these in Minnesota, Colorado, there's an ability in a lot of cases to build a larger project with very little or no extra subsidy, particularly if you're in a QCT, using the equity from a bond deal. And that isn't something that we used to be able to see beforehand. There would just be too large of a financing gap, but that gap seems to be able to be closed pretty routinely on larger projects. And, it's mainly 250 units or above. But I think that's kind of fun to see effectively market rate deals, but they're capped at 60% AMI, but that can be financed in a more broad fashion. On the investor side, the one thing that we are seeing is somewhat of a trend in bond deals, and we saw this pretty commonly in 2009 through 2012, is a hesitance for some investors to do bond deals because of the additional leverage and perceived additional risk that is triggered by that additional leverage. And so I think it comes back to knowing the appetite for your investor group and making sure that whoever you're approaching is a group that is comfortable with that additional leverage provided by the bonds.
Very good. John, we really appreciate your time today. A lot of really good information. So thank you very much, John. And listeners, thank you for joining us. Thank you for listening to BuzzHouse. To receive a notification when new episodes are available, please subscribe to BuzzHouse, a Baker Tilly podcast, wherever you get your podcasts. For additional resources around multifamily housing, check out bakertilly.com. And if you have a suggested topic, please send them to build@bakertilly.com. That's BUILD@bakertilly.com.